All right, now I'm going to do a video on section 13.5, financial investments. So this is dealing with stocks, bonds, and mutual funds. All right, so I'm going to start with stocks. So when you buy stock in a company, that's actually making you a part owner of the company. So you're going to share in any profits that the company makes, and your share of the profits is called a dividend. Okay. All right, and then the way you make money with stocks is you buy them now at one price, and then hopefully the stock is going to go up in price, so when you sell it, you make a profit. So the profit you make by selling for more than you paid, that's called a capital gain. All right, so sometimes that's negative. We might call it a capital loss in that case. And that's going to happen if you decide to sell and the stock has gone down in price and is less than what you had paid for it originally. Okay? All right, so by a return on your investment, okay, ROI it's sometimes called, return on your investment, spell that right. All right. What that is, it's the difference between the money you made, which would be if the stock went up in price, would also include any dividends, and what you paid for the stock, which would be the purchase price of the stock, but also would include other fees that might be involved when you buy or sell stocks. Like sometimes you have to pay, a bit of a commission to a broker in order for them to do the buying and the selling for you. Okay? So the difference between what you make and what it costs you, that would be the total return on your investment. Right, and then how much a share of stock costs is determined by stock exchanges that keep track of the supply and demand for particular shares. Okay. All right, so let's go ahead and look at a problem here. So here we have a company X, and we're going to buy 100 shares of stock in this company. We're going to pay $28.50 per share. A year later, we're going to get a dividend of 60 cents, and the stock price has gone up to $29.75 per share. So we have a bunch of different things we're going to find. So the total cost of the stock, we don't have any information about broker fees or anything, so the total cost here would just come from taking the number of shares times how much they cost per share. So that would be $2,850. So that's like the purchase price, right? How much you paid for the stock. Okay. Now, to calculate the dividend amount, we'd have to go and notice that they got 60 cents per share. And remember, they had 100 shares. So we'd multiply 100 times the 60 cents, and that would be $60. So that's the total dividend amount. Okay. All right, now to get the capital gain, I first need to find out how much I sold it for. So 100 shares, the price of the stock was now $29.75. So $2,975 is what I was able to sell it for. That's the selling price. Okay. All right, now, I'm not finished with part C because they didn't ask for selling price. They asked for capital gain. So it cost me this, or I got this much money when I sold it. Okay. And when I bought it, it was $28.50. the difference between the selling price and the purchase price, just that $125, that's your capital gain. It's a gain since it's sold for more than I paid for it. And a capital gain note does not include the dividend. You're going to need to watch that. That's probably the trickiest thing. Note, write it over there. Capital gain or loss does not include a dividend. Okay? So that's for this. The note is for that. The capital gain doesn't include the dividend. It's just selling price minus the purchase price. All right? Now the total return on your investment does include the dividend, and it also would have factored in any other costs that you might incur when you buy or sell your stock. Okay, so we don't have any of those, but we do have a dividend. So the total return would be that $125, that was my capital gain, and the $60, that was the dividend that I got for the year. So that $185 is my return on investment. Okay, return on my investment. And sometimes what's good to know is, well, what percentage does that turn out to be? So that $185 is what I made when I invested $2,850 to purchase the stock. So when I do that, that turns out to be about 0.0649, which is about 6.5%. So by doing that, you can compare a little bit with that percent tells me that that's doing pretty good. It's doing a lot better than my bank account. They don't pay nearly that amount of interest. Okay. All right, so this video I'm trying to do everything related to stocks. Okay, so now this portion right here, this is a sample of what a stock table might look like at one of the exchanges, one of the stock exchanges. And you have some problems in homework where you might be asked to answer certain things, like you might be asked for what's the closing price of this stock. So that would be the 1879. It makes sense that you would look for where you see something like closing or close. Okay. All right, and then that net change, that 0.03, that's just telling me that the stock, that's 1879, was 3 cents higher than it had been the previous day. So it kind of lets you see how that stock is trending, at least one day's worth. One of the trickier ones is if they ask you for volume, because of the fact that the volume is in hundreds. So 1411 isn't the answer. It would be 141,100 really. You'd have to multiply by 100, right? So your answer would really be 141,100 shares. Okay? If they ask you for the dividend, then it seems like logical that you would look for something that seems like the word dividend. So DIV, 53 cents would be the annual dividend that company pays. If they wanted the high price in the last 52 weeks or the low price, you could go here to get the high or the low price in the last year. Okay. All right, so you might be asked several different questions that involve just looking at a stock table and figuring and answering whatever it is they're asking you for. Okay. All right, and then I want to talk just briefly about how a lot of times we use and almost need to use a broker to do the transaction, though this has gotten a lot better because now there's a lot of discount brokers out there. What was that one? I think it was called Robinhood, that enabled just like an average person to to get involved in the stock market, because a lot of times stock markets, getting involved in those, only people who had accountants or knew how that worked would ever be able to do it. But now it's just much more accessible. Okay, so here is like a table that shows you some of the costs that might be involved if you were trying to purchase stock from some company. So if you went to Firm B and you wanted to do an automatic online purchase, they might charge you $1 for that. All right, but if it's broker assisted, then it might be a whole lot more. Like for Firm B, that would cost you almost $20. Okay. Firm C just charges you a percentage, probably, of the cost of the stock that you're purchasing. Okay. So full service brokers, they might actually give you more advice about what you might buy. They'll do the research for you and make some recommendations. And they might help you with other things like planning for retirement and tax advice. But relatively recently, there's been these more and more discount brokers that are there to help you, okay, execute your purchases and sales of stock. All right, so they might help you with some educational information, but they normally don't recommend specific stocks, and they don't provide a lot of advice about how to manage your money. Okay, so these brokerage firms, they're going to be charging a commission. So it's like a fee that the broker earns. Okay. Full service brokers, commissions are normally a percentage, like 1 or 2% of the value or the principal of the purchase or sale. And then discount brokerage firms, they normally don't charge special fees, but then those discount firms look at whether your transaction was done online or whether they had to assist with that. Okay.